Hello and welcome to our viewers on cruxinvestor.com and also to our listeners on Cruxcast, our new podcast series. We're going to be speaking today with Mike Alkin. He's a fund manager specializing in uranium. So, hello Mike, how are you?
Good, Matt. How are you?
Good to be speaking to you. So where are you? You're in New York?
I'm in New York, Long Island.
Fantastic. Okay. You made a bit of a life choice. You're an ex hedge fund manager.
I am.
But you made a bit of a life choice there, and you decided that uranium was the way forward. Do you want to tell us a little bit about how that started?
Yeah, I was in the hedge fund business, long, short, analyst, became a partner over the years at a few different funds. Last one was a multi-billion-dollar fund. And in 2015, my daughter became very, very ill, and we almost lost her.
Sorry to hear that.
So that was after a long career and a lot of travel and being weekend dad, that kind of changed my view of things. And so I decided at that time that thank God she survived, and she was in the hospital for quite some time. And I'm very happy to say today she's still has a condition, but she's thriving. But we didn't know that at the time, so I just thought I would kind of be dad. And
good on you.
After several months, it was clear that she was turning the corner, and she was, and I was home, and I was taking the kids to school once she went back to school, and I was trying to make dinner and help out around the house, and my wife said, like, time out. The reason we've had a great 20 plus year marriage is you're always on the road or you're always working, and it works out perfect.
I know the feeling.
Encroaching on my territory here. So I had to decide what I wanted to do, and it wasn't to go back and work at that grind. And the big firm I was at had morphed into a family office, or was morphing into a family office, and there were changes taking place there. I didn't want to start a long short hedge fund because the capital raising environment is difficult, and I believe it's really hard to generate alpha, right? To above average returns when you're a couple of guys in a Bloomberg terminal. I call it two guys in a Bloomberg. And I feel as though that portion of the business is on the back nine, right, if you will.
Yeah.
And the bigger funds have more assets and more resources and everything else at their disposal. So I really was just home managing my own money, picking my own stocks. And throughout my career, my first half of my career, I was a dedicated short seller. I dug deep in the weeds from a forensic standpoint, both in the field through the financial statements, and would just look for companies that were either just, I thought, overvalued, but had a catalyst to get the value realized that I thought it was worth, or just bad companies, bad guys, frauds. But that was the first half of my career. So obviously, as a short seller, you have a contrarian bent. And on the long side, the firms I were at were deep value oriented in the middle to latter part of my career. With great exposure to natural resources, oil and gas, I had exposure to that. So with time on my hands, one of the things is when you're at a fund, if you have a portfolio, a segment of the portfolio, you may have 20, 30 investments. And you're always in different industries. When you're a generalist, you're always chasing your tail, working a lot, but you don't really, you focus in on those top names, but you don't have the time to do. You understand as somebody
who's been there.
Speaking to the choir, right?
Indeed.
But now for the first time in my life, I had time. And so I was able to choose no performance pressures to perform day to day or week to week or month to month. So it was what is interesting to me. And along the way, and somewhere along the way, uranium crossed my desk. I'm screening for new ideas, what's been beaten up, what's excessively priced on if I was looking for shorts. And I know myself, and uranium crossed my desk, and I said, we looked at that in 2007, we looked at it in 2011, But at that time, we looked at it very, very briefly. We had a lot going on. In '07, it had hit, the price of uranium had gone from $9 a pound a few years earlier to 137. And we just had a lot of investments at the time. So we didn't spend too much time, maybe less than a week. Concluded that it was complicated. The industry was very complicated, so we moved on. 2011, after Fukushima, the accident there, we did the same thing and just said, you know what, we can't draw a conclusion. So I had very, very faint familiarity with it. But what attracted me in the latter part of 15 was, this was an industry whose market cap at one time exceeded $150 billion. The number of companies that were in the uranium or had the name attached to it was over 500. And when I was looking at it, the market cap, when I started to look at it, the whole industry was sub 5 billion. Yeah. And the price of the commodity was down over 90%. And the number of participants from an institutional standpoint were virtually non-existent. And so I thought, well, that's interesting. So that's what piqued my curiosity. And then I started reaching out to people I know on the sell side, and I asked for models. Let me see what the industry looks like. And I started getting really dated models. And I thought, I've been doing this a long time now, a few decades, and I can't recall a time where I saw an industry that looked like it was left for dead, that had declined this much. What I didn't have was that knowledge of the growth drivers of nuclear power. And that's one of the things, as a Westerner living in the States, or if you're living in North America or Western Europe, nuclear power is a 4-letter word. And so my awareness of it was, it's dying, it's decreasing. I had more awareness of wind and solar because somewhere along the way, as a short seller, I was looking at component makers and other stuff. So I said, let me come at this through the eyes of a short seller. Let me prove the bear case. And the first thing I did was try and understand the growth drivers. And I wanted to understand the role of renewables, wind and solar.
Can I ask, Mike? I mean, had you been involved in energy in any way as part of your previous portfolios?
So randomly, but the firms I was at, two firms, both had dedicated oil and gas, energy. Right. So as a partner, I was always around it. So knowing what the drivers were, and then other resources as well. But no expertise whatsoever. I still don't. I'm not. I laugh when people say the uranium expert. I mean, I think
and they do.
I think the greatest asset an investor can have is to be a generalist, especially when you're looking at deeply cyclical businesses. I'll give you an example, Matt. I won't look at biotechnology companies, for instance, for me. There's no amount of knowledge I could learn that would make me be able to understand what's going on.
Yeah.
Deep financial companies that are big money center banks, they're so opaque. Forget it. But in most other things, if you're a reasonably bright person and you bring a clean slate to it, and you know what to look for, the drivers of supply and demand, it's not that complicated. Now, I will say the nuclear fuel cycle, by orders of magnitude, once I started diving into it, was the most complicated industry I'd ever looked at.
Well, we're going to get into that for sure.
Thank God I didn't need to be a nuclear scientist, because I would have bailed out.
Right. So you've made the conscious decision as a life-changing event for you, and a life-changing decision you made. You think, right, uranium seems to be an opportunity which, for whatever reason, no one else is paying attention to. So do you feel you got in at the right time? You got in a bit early? Do you think others are late?
So I started the Sachem Cove Partners in June of 2018.
Right.
Okay. Late 2015 is when I started peeling the onion back. And that was literally modeling out every nuclear reactor on the planet, because I felt the data was dated. And it was looking at every reactor, when it was built, when the license expired, when was there a renewal in place, was it going to happen? And I went country by country and I looked at every country where nuclear power is derived and what is the political atmosphere? What is the atmosphere for growing it, shrinking it, or staying neutral?
Mm-hmm.
And what I did as I was trying to understand demand by building it from the ground up was to go draconian. So if there was a country that was talking about shutting it down or reducing dependency, that went into my numbers. And I did that, and I looked at planned and future reactors, and I took only a very small portion of those because you don't know what the future is going to hold. And then those reactors under construction. And I wanted to understand the role of nuclear versus wind and power. And wind and power are growing. People tend to turn into a zero-sum game, but I don't believe it is. So when I did all of that, and that took several months. Reactors under construction, existing reactors, a small portion of those planned and proposed by country, and closed down a lot of them. I concluded, you know what, this is actually a growth business. It's a 1.25%, 1.5% grower. And if I want to get a little goofy and bring in some of those other reactors, I could get 2.5%, 3%. When I did that, I said, wait a second, this is an industry that's come from market capitalization of over 150 billion to less than 5 billion. It's 11, 12% of the global electricity grid. It's growing. There's a disconnect here. And there was only really one major company, and that was Cameco.
Yeah.
That of any substance of market cap. And then I realized that this was the big thing for me. I have never in my career seen an industry that is critical to the infrastructure of certain countries in the world from an electricity standpoint that basically had been left for dead by institutions. And that's when I said, let me really dive into the supply side. And as I dove in there, that's when I started this. Now this was 2016, all of 2016, the latter part of 2015 is when I really devoted time to this, never speaking publicly about it.
Right.
And then the first time I ever spoke publicly was in March of 2000 or April of 2017.
Right.
On Real Vision TV.
And what was the reaction?
It was good. It was well received. It was, uranium. Forgot about that.
Yeah.
And then I was asked to speak at another investment conference in the summer. And I started to I think, validate in my mind that there was something to the thesis. Here's a guy who a year and a half ago couldn't tell you anything about uranium.
Yeah.
I'm not a mining engineer. I'm not a geologist. I know that. I know what to avoid in terms, and I know where to go find help for that stuff. But here I presented a thesis that was a little different, and they're up on YouTube. People could look at them. And I explained the industry and the fuel cycle, and you would have thought I reinvented the wheel. And I had uranium companies reaching out to me, asking me my view on the global macro of uranium. And I thought something's not right here. And so that was really then. And now what determines, it's interesting, the early question. I don't think about it in terms of, especially as a private investor, well, now with a fund, with my investors knowing that there's a longer term time horizon. I look at risk reward. The way I view this all, Matt, is there are, I like to take fewer swings at the ball, the better. And so in this particular case, it's all I measure is risk reward. What is the amount of upside I have versus the amount of downside? And if I take care of my downside, and that's how I was taught in this business, and that's how I live this business. If you focus on the downside and where you could be wrong and where you're going to go if it's wrong, if the fundamental work is right, the upside will take care of itself. So normally I'll look for 3-to-1, 4-to-1. I like that, 4 times up. So if something's 10% down, you have 40% up, right? For simple math, for those who are just learning what that is.
Yep.
When I started looking at uranium, it was orders of magnitude different. And I started looking at the downside, and I said, okay, well, I think I can get my head around the downside. I'm very comfortable with what that downside is. I don't care if it takes 1 year, 2 years, 3 years. because I can't get that upside anywhere else. And so that's kind of how I think about it. Now, at that time, the price of uranium was in the mid 20s, probably low to mid 20s. Today, here we go, a couple of years later, it sits in the low to mid 20s. The equities have had a little bit of a fit start. So from a risk reward standpoint, I'm sitting there thinking, my goodness. And there have been a couple of things that have caused a little bit of a push out from the price realization standpoint.
Yes. Well, let's come on to that. But and here's the bit where the followers of and watchers of this video might, the experts might feel that this isn't for them. But let's do this for the people new to uranium. Okay. So
sure.
Let's start with the basic. I want to look at as the way that you and I have done in our careers. You break down all the variables and you try and work out what each of those is, and then you kind of put them back together here. So. Can we start really basic? What is uranium? What types of uranium is there? And what are the uses? Just helicopter view stuff for the beginners.
Sure. Yep. So uranium is abundant in the earth. Getting it out of the earth economically is different. So it comes out either one of two ways: conventional mining.
Right.
Which is open pit or underground, or what's called ISR, in situ recovery. Some refer to as ISL mining. Mm-hmm. And basically, we all know what an open pit or underground mine looks like. If you think about ISR, it's basically think about what you would see when you see an oil or gas well being drilled. So you drill down, you put injection wells in, you put a solution in, you separate the uranium from the rock, you bring it up through pumps that are bringing it up, you process it, and those are the two methods. The ISR mining method is less upfront capital expense, but a relatively high ongoing expense to maintain it. And you also typically have decline rates that are fairly high.
Right.
So that's the method. Now, once it comes out of the ground, it gets processed and dried into drums, and you'll hear the term yellow cake.
Yep.
And it gets put into drums, and it looks yellow. From there, it then gets sent to a conversion facility where it's turned into UF6. It's a gas. From there, it gets sent on to an enrichment facility, where for nuclear power, when it comes out of the ground, the energy content is 0.7%. To power a nuclear power plant, it needs to be enriched to between 3 and 5%, and for a nuclear weapon, over 90%.
Right.
And it goes through an enrichment plant. And then from there, it gets sent off to a fabricator, where that enriched uranium product, EUP, is turned into very small pellets the size of my thumbnails. And if you stay with me, that's a pellet.
Wow.
That's it.
There you go.
And you put a lot of pellets into the fuel rods.
Right. Interesting. There you go.
So from there, it then gets sent to a nuclear power plant. It gets put into the reactor. Now, the length of time for that to occur is 18 to 24 months.
Right.
That's the fuel cycle.
Right. So again, just to take it back to sort of what people might understand, conventional mining terms. So in the sense that gold comes out of the ground with there's different levels of grading for a lot of commodities, or you find it in different quantities. Here, the same rules apply, I guess, and then the enrichment process is where you kind of...
Yeah, so where the grade matters is the economics of the mining.
Right.
Okay.
So
the higher the grade, the less rock you got to...
So the same rules apply. Okay. When I think of uranium, I think of Kazakhstan, Canada, Australia as the big ones. But you say it's also everywhere. But those seems to be the three richest.
Well, it's not everywhere in the world, but where it is, there's plenty. It's getting it out economically. That's
right. Okay. So why don't you tell us about a little bit about the amount of uranium there is in the world currently? What where you think it needs to be?
So, I mean, from a demand perspective, and you asked earlier about the uses. Most of the uranium that comes out of the ground and most of the demand comes from civilian nuclear power.
Right. So
And then
nuclear reactors, as the Joe public would know them as. Okay. And you talked about, so you've identified obviously how many reactors there are in the world currently, how many are being built, and how many are in planning.
There's 450 they call them operating reactors, but they're not all operating.
Okay.
And from that number, there were 54 in Japan that went offline after Fukushima melted down.
Right.
After you had the accident at Fukushima. 9 have since restarted. And then you've had starts and stops, but along the way. So in the 420-ish range, that's actually serving electricity to the grid. There are about 55, 56 reactors under construction around the world.
Mm-hmm.
And there are hundreds of reactors in the planning and or proposed stage.
Right, okay. So that gives us a sense of those numbers. And then you also mentioned earlier the fact that there used to be a lot of uranium companies that existed. And I guess with the peaks and troughs of the market and the spot price coming in and out, and these black swan events of Fukushima, 3 Mile Island, etc. These companies have increased and declined in equal measure. So today, how many producers are there?
So if you think about the nature of the natural resource industry, especially the junior miners, when the price of uranium went from $9 to 137, everyone wanted to become a uranium miner. And then the cycle turns and they're stuck. So that's a lot of those companies, right? So the kind of the way I think about there's state-owned production, right? Countries, state-owned, and then there's private and public companies. So you have producers, near-term producers, and exploration and companies. From a production standpoint, as you look around the world, 41% of all uranium comes out of Kazakhstan. About half of that from Kazakhstan, roughly, comes from the state-owned entity called Kazatomprom. Kazatomprom was, if you go back to the mid-2000s, was a very early 2000s to mid-2000s, was a small player, and so was Kazakhstan. And they've massively expanded their reach to now they're the number one player in the world. Kazakhstan's number one country in the world. Kazatomprom is also the largest one. Now, they just floated 15% of the company to the public in November, December of last year.
Yeah.
Then you get into your other producers. You would get into Orano, which is the state-owned French nuclear giant. Yeah. And they have production in various places. Niger is a big producing point for them. They also have joint ventures in Kazakhstan as well. The next one you get to is Cameco in Canada, in Saskatoon, Canada, which has really been the leader in the space from technological standpoints. They own 2 of the biggest mines in the world, McArthur River and Cigar Lake. They're a 20-ish% producer. And the fascinating thing about this is as you start getting Kazatomprom and Cameco, just those 2 alone are over 40%. Kazakhstan and the joint ventures in Kazakhstan and Cameco are over 60% of production. So you have a very concentrated production base amongst your majors.
Yeah, and I do want to talk about that in a minute in terms of their control in the marketplace and their influence in the marketplace, and we will come on to that when we get back into the sort of the more meaty areas of the discussion. But just to kind of continue this conversation with regards to understanding what the variables are, if you don't mind. So there's the political or geopolitical component to this, because it's a very emotive subject. The psychology of it is definitely key driver between thinking of 20, 30 years ago, and I do see that changing. Obviously, you've got influencers like Bill Gates, affecting people's perception, and there's a lot of work being done around that. So, I mean, if you don't mind, I mean, can you give us your view on the sort of geopolitical state? You did touch upon it there with obviously Cameco and Kazatomprom and Orano. I mean, how do you see that at the moment? How does that work?
So, for decades, the United States was the leader in nuclear power,
Right.
nuclear power, nuclear weaponry. And it's an important role to be at the table and a leader in the fuel cycle, is because through the various agencies, you can, and technology, when you're building reactors, you can play a role in non-proliferation because you have a seat at the table and you can help dictate who gets what and where and so on and so forth. If you go back to the 80s, during the Cold War peak, the United States was consuming 45, 50 million pounds a year of uranium and producing in the 40 million pound range. You fast forward to today, the United States produces less than 1 million pounds and consumes close to 50 million pounds. Geopolitically, it's been a sea change over the last 15, 20 years. And what you see now is that the Russians and Chinese, and you have the Koreans, but the Russians and Chinese are dominating the nuclear fuel cycle. And you think about Russia and energy and how they use their influence in natural gas, let's say, on Western Europe. What they've done in the nuclear power space, for them, they should be commended because they're using it to their advantage. The nuclear power growth story is not a developed world story. It's a developing world story. And so in the West, it might be flat. It could slightly decline a little bit. We get a few come on the grid, but it's neutral. In the developing world is where all the growth is coming. And what the Russians and the Chinese have done is have vertically integrated the fuel cycle. And so if you are Rosatom, the state-owned entity, or if you're the Chinese, which has a couple of entities, they will go into these developing countries and they will say, we will, most of these countries that are becoming more, they're economically developed, they have to deal with coal and pollution, and pollution kills 7 million people a year. So what they will go say, well, look, we'll bring you clean air, we'll bring more people in scale onto the grid with nuclear power, right? So we increase standards of living, and we will finance the reactor for you, we'll build it for you, we'll provide the uranium, the conversion, the enrichment, the fabrication, we'll help operate it for you, we'll get you set up. Now they own you in terms of that, on that regard. So you're dependent on them. The West has, when you're in China or Russia and you're building a reactor, if it's 5 or 6 years and it's $6 billion, it's what it is, a little bit here or there. In the West, it's twice as long, twice as much.
Yeah, and I do appreciate that. I mean, I've read about this and the way that the Chinese and the Russians coming in and they pay for everything, and they're also bartering nations. They can be paid in other mineral resources as well. So I do quite like that. And with countries like Africa, where the GDP isn't huge and the available cash is not huge, this is a very, very attractive proposition. But it also means that relationships get built, which is not necessarily what America wants to see. So that's what that's this whole geopolitical component is very, very important, especially with this recent 232 piece in the marketplace, where I think the proposition there is that it was on the basis of national security. But do you think it is about national security?
I do. As an American, okay. I do.
Right. So tell me about that, because this is all intertwined, isn't it?
Yeah, it is. So the Americans have lost their seat at the head of the nuclear industry. I do believe that. And in many ways, and from building reactors to enriching uranium, enrichment is so critical. Without enriched uranium, the reactors don't work unless it's what's called a CANDU reactor up in Canada, where there's certain reactors that don't need enrichment. Right. But for the most part, it needs to be enriched. And in the United States, there is no enrichment that is owned by the US. There's a plant in New Mexico owned by an English, Dutch, German conglomerate called Urenco. But so the United States, consumes 50 million pounds per year. and most of it in the nuclear reactors. The Navy is known as the nuclear Navy, right? The Navy has been nuclear-powered submarines and carriers.
It's a huge number, isn't it? How big's the fleet, the nuclear
Number.
fleet?
Oh, it's hundreds. Yeah,
Yeah.
and it's critical to the Navy, and they have reactors all over. They're floating reactors, and then there's other things that nuclear is used for medicine and whatnot, but most of it's nuclear power. But here's a country whose 20% of its electric grid, so 1 out of 5 homes or businesses, are powered by nuclear power. Yet it imports 99% of its uranium needs.
Right.
And there's no substitute in a nuclear power plant. You can't substitute something else. It's uranium. That's your feedstock. And so what you see, what winds up happening is the production here is less than 1 million pounds, and they import the rest. Now we have our friends, the Australians and the Canadians, who are just like we're friendly. They're our best mates. But in any given year, it could be from 30 to 40 to 50 to a little bit more that will come from what one would argue could be the Russian sphere of influence.
Right.
Kazakhstan, Russia, Uzbekistan.
And why is that problematic for you? Why is that not just open markets? What is America nervous of in that scenario?
So the Russians will easily use natural gas as a geopolitical weapon into Western Europe.
We see that with Nord Gas 2 coming into Northern Europe. Yeah.
Exactly. And so you have something that's so critical to your infrastructure and to your military that the Navy is what enables America to be America. It can be anywhere in the world, and it's I believe that the U.S. naval fleet is the size of the 10 next biggest naval fleets.
It's something as crazy as that. Yeah.
It is something as crazy as that.
Yeah.
And so it has become reliant upon it. Now there are stocks of it, but that's not forever. That's going into the middle of the next decade.
So you're saying even with the partners, Australia, Canada, with your Canadian friends, you're saying that you don't want to be beholden to them or reliant on them,
right.
Even as
Well, so it's a matter of So it goes beyond the friendship, and so if we look at really what it is, and it's the utilities will make the complaint that, and by the way, I should preface this. I don't care as an investor which way 232 comes out. It doesn't matter to me.
Right.
As an American, I'm inclined to want to see something happen, and here's why. If we think about the production that comes out of Australia, and it comes down to economics.
Yeah.
The Australians have Olympic Dam, which is uranium is produced as a byproduct of copper production. So uranium will come in or out depending on what copper's doing and how much they feel like investing in that. Right. And then you have 4 Mile, another mine down there, which is a few million pounds a year.
Yeah.
Now you move up to Canada, our great friends a little bit to the north of us, and they have one producing mine, Cigar Lake.
Because has been closed down, right?
MacArthur River is of 18 million pounds per year, right? So what that's saying is, and this is where I think the disconnect, and we'll go into as much length, depth as you want to.
Thank you.
Is the economics of such are, well, first off, the Canadians and the Australians. Now BHP will be more of a spot seller, but 4 Mile will be a contracts. Cameco has 150 million pounds of contracted future deliveries. Now, they are producing out of a joint venture in Kazakhstan called the Inkai JV. They'll get 4 million pounds a year from that. They've got Cigar Lake producing, and you get 18 million in their portion of it. But then as you start to, that's not a lot of pounds. And MacArthur River is offline because the economics are such where it doesn't make sense for them to produce the highest grade uranium mine in the world at prices that are not economically incented. So yes, we can say, hey, Russia, Canada, Australia, the Russians, let's say, make it up. The Russians have, and the Kazakhs are withholding uranium. And by the way, last year in the Duma, and the first version of it was unclear how it's come out, but the Duma gives the president the authority on certain critical minerals to say, yep, not sending it in. Now, do you want to be at that? Because what happens is the utilities will keep a couple of years of inventory around. Now, if you start to exhaust those inventories, and all of a sudden it's a 2-year fuel cycle, and you in the spot market, as we just saw from Cameco announcing on their conference call, they couldn't find 1 million pounds in the spot market. So now where do you go? Well, you've got India with a voracious appetite for uranium. You've got China with beyond a voracious appetite for uranium. The world has a lot of people who want uranium, and so maybe their production isn't there, which it's not now. All right, you've got these 2 in Australia and 1 in Canada. So we can't just say, oh, we'll trust them, because the economics don't make sense for them to be able to meet the demand of 50 million pounds. That's a lot of demand. That's a third of, that's more than less than a third, but it's a big amount.
Yeah, I mean, so many questions. But let's
national security.
Yeah,
manufacturing, it's powering manufacturing facilities. If in time of need where you needed to ramp up manufacturing, who knows what the world will bring if you have a war and you have a 50-year grid that's in peril. That can be national security.
So there's a few things you said there, which obviously in conjunction with 232, you've got utilities with contracts, you've got producers with contracts, long-term contracts. And there's a bit which is kind of confusing me here in the sense of 232. It was brought by, I think, Energy Fuels and UR Energy, put forward by them. We're not quite sure of the detail as to what is being asked for, or indeed what will be found by President Trump and his team. But it seems to me that it's kind of frozen the market. The utilities are waiting to see what's going to happen. Like for you just said, I don't care as an investor what the announcement is. Doesn't affect you. But for these guys, it's a big deal, because they're committing to forward contracts at one price and it comes out another.
You see me shaking my head.
Right. Okay. Right. You're feeling the same pain, right? Or same confusion, should I say?
No. I'll tell you why. I have it. Can I step back for a second and answer that?
Yeah. So it's a big question.
So one of the biggest surprises I have had in my journey in the last 4 years in the world of uranium is the lack of diversification and analysis in the actual uranium market by all industry participants. There's a handful of industry observers that opine with numbers. And some are handcuffed by what they can include in it. Others have their own reasons for putting out a high, low, and base case that you can drive an ocean liner through, which allows you to morph to wherever the market is. But one of the things that I think surprised me the most was in speaking with many, and I won't name names, but many uranium mining companies, was the reliance upon those entities for their numbers. Right. And one of the things when I started diving in here and peeling it back and spending a year and a half, and the light bulb went off and went on and said, these numbers are not economically driven. They're project driven, but not economically driven. Some of these numbers.
What do you mean by that? Tell me what you mean by that. Project driven versus.
So if you're one of the entities, you because there was a great uranium cartel, great book too, called The Great Uranium Cartel in the 70s and 80s.
Right.
And it was front page news around the world, and people went to jail over it.
Right.
And so if you go to one of these fuel conferences, what you'll see a uranium industry conference, you'll see on the registration thing, you'll see a sign that says, "Please do not talk commercial activities. Do not talk terms. They're afraid of price collusion." And so as the sausage is made in one of these entities, the cost of these projects in the future, the commercial cost to maintain a project that's in production is counted in future production.
Yeah.
And so,
Yeah.
so, but these companies outside of the state-owned entities are, most of them are public companies. And at some point, when the cost to produce something is meaningfully below the cost that you can sell it, that is meaningfully higher than the cost at which you can sell it,
Yeah. Yeah.
you have to cut production.
Yeah, I think it's like
Now,
it's claiming
capture,
revenue going forward is in other industries. Other industries do it, and they do get caught out. But why were they allowed to do that?
well, it's their method of forecasting, because rather than wanting to be, they don't want to be forecasting price, forecasting costs, and they rather not do that because they don't want to be perceived as colluding with the industry, with
Right.
either side of the industry. So here's today what it is, and then here are all these projects that are on the drawing board. Let's assume if some of those come in, and all of these projects that are in production right now, well, they're going to stay in production. Well, that's not the case. There's many reasons why they're going to come out, and economics is the biggest reason.
Yeah.
And so, as I started thinking about that, and I started just working my way into the fuel cycle and talking to fuel buyers, CEOs, people in the industry who've been around for a long time, traders, enrichers. What I realized is everyone's using the same set of numbers. It's a closed loop.
Right. But they've all got their own business model, but they're using the same data. Is that what you're saying?
Yeah, that's what I'm telling you.
Right.
Here, I could count on one hand the guys that are doing their own numbers.
The industry, the utilities are frozen. They're waiting for something to come out. They're not in control of any aspect of this. So, well, I guess a slight segue. Sorry. Do you think it was a smart move by Energy Fuels or UR Energy to do this?
Great question. So,
It feels to me like a chess move.
232, yeah. I never knew what 232 was before it was announced in the middle of January 2018. Now,
Yeah.
in my presentation in June of 17, I talked about the U.S. conundrum and how the Russians have the U.S. in checkmate, but I didn't know what that answer was.
Yeah.
My view is very simple. So the U.S. miners would tell you that the foreign imports, specifically the Kazakhs, and then you're going to see the Chinese coming in, and Russians are all state subsidized, and they don't have the same mining methodology, and they don't put the same environmental standards, and so their costs are lower. But it doesn't matter necessarily what the costs are because the state will subsidize.
Right.
And as a result, it's hurting them. Right. Now, that was never part of a thesis that I had, because my view is the world is in a deficit now, and that deficit will continue to increase. And in 2017, my thesis was certain project by project, certain projects can't stay online. They will come out of the mix, and that will lead to a deficit. And that deficit will benefit all of the miners. Well, I shouldn't say all, because many of them, but those with bullshit projects, because there are some of those in the junior mining world that sell a good story.
Yeah.
But those that with real projects will benefit. Now, when you look at the U.S., my belief is if 232 came and the U.S. government, if Trump said nothing, you get nothing. I believe there's a deficit in the world of uranium right now that UR Energy and Energy Fuels will be fine.
Undoubtedly, and I know the Energy Fuels guy, Mark, because we spoke to him. They're sitting on a lot of cash as well. That also helps with optionality. But I guess the point I'm trying to get at is just to understand why they did it. Is it for the good of US producers, or is it for the good of those two companies only? I should say there's a global deficit probably currently and definitely coming. So everyone with cash, with a good asset, will be fine. I get that. But do you think they specifically did this for their own benefit, or for US producers and developers?
So, yeah. So they're the only ones who could answer that question. Right. I can't speak for them.
I thought it was a great move. I thought it was a move that was very brave and very bold. I take my hat off for that. Yeah. But it has paralyzed the market.
It has, and it's interesting because if we say it's 25%, make it up, that's what they say.
Sure.
Trump says, sure.
Yeah.
That's 12 million pounds a year.
And you told me
It's
we
going to
produce
take
1 to 2 right now.
less than one.
Right.
So that's going to take a while, right? And Cameco can do 3-ish, 4-ish energy fuels, but there will be others that would benefit from it.
Right.
Now, I also think when I say from an American standpoint, I can't help that America put themselves in this position on the whole nuclear fuel cycle. Do I think that there should be more production in the United States so that there's less dependency on imports and those coming from those who may not have the U.S. best interest? Yes.
Right.
So when you asked me earlier, from an American's perspective, I'd like to see us less dependent. But I do think the markets will get you there because I think the fundamental issue right now is the price of uranium is simply too low. And when you go back to the start of the last cycle in 2003, when the price was $9 or $14 in 2019 dollars, and it went up to 137 in the spot market at a peak, not the average price. The average price was about $88, $89 that year in 2007. That was driven by really uncovered demand, right? And if you go back and look in 2003 and 2004, right, because historically most of the industry is done, transactions are done through long-term contracts.
Yeah.
Right. It was at one time in the early 80s, it was 85, 90, in the early 2000s, 85, 90%. Now it's roughly 75 to 80%. But those are contracts that are 7, 8, 9, 10 years in length. And as utilities start to bring their inventory levels down, and it takes them a couple of years, and they start to have what's called uncovered demand, not covered by contracts, what they then start to do is they start to forward contract a couple of years ahead of time. Now, if you look back at the last cycle, the similarities to this cycle are stunning. If you look back in 2004, you had teens % of uncovered demand over the next year, and then it went a little bit higher, and then a little bit higher, and then 4 years on, it was 80 to 100% of uncovered demand. Well, you look here, and you're seeing the same trajectory, where uncovered demand close to 20%, and then it gets close to 30%, and then close to 50% over the next 3, 4, 5 years. The utilities in the last cycle were contracting a few years before they had any uncovered demand. Fuel buyers are very smart people. I think sometimes as an outsider in the industry, sometimes, and I'm outspoken on it, sometimes the fuel buyers will say, well, you don't think we don't know what we're talking about. On the contrary, the fuel buyers have played this cycle so wonderfully, right, that it should. And I've said this, I spoke to a group of 150 of them at the Nuclear Energy Institute in October. They played it beautifully and the miners did not.
So, okay, well, tell me about that. Why do you say they played it beautifully? What have they done deliberately?
So these contracts are 7, 8, 9, 10 years. And
right.
if you look at where the price was in 2003, 2004, 2005, it starts going up. People say, well, what's the price? What's your price target on uranium?
Yeah.
Well, if you go back when people were signing, when the price of uranium was at $137, they weren't booking contracts at 137. No. A uranium miner is, if they're prudent, are going to have a mix of fixed contracts versus market-related contracts, maybe 40-60, 40 fixed, 66. And as those prices are going up, they've got to lock in. They start locking in prices, so the price you realize over the long term is meaningfully lower than what the actual spot price is. So what you start seeing is with these prices, the prices will start to accelerate ahead of time, right? They start moving up ahead of time, and then what you see is it starts to feed off itself, because there's not a fuel buyer on the planet that's going to get fired for the price that he pays for uranium. The fuel buyer will get fired if he doesn't secure the supply of the uranium.
For sure.
right? And it's a very important distinction. And I think history is so important to look at with
So,
any of these
so
cycles.
explain that. So I think what you're saying there is that the uranium as itself, as a percentage of the cost of running an energy operation,
Yeah.
is not de minimis, but it's insignificant. The cost of
So
shutting
if
down would be
yeah.
the real
Yeah. So
cost.
if you think about the a coal-fired or natural gas-fired power plant, the input, the fuel, the feedstock, coal or gas, is 80 to 90%.
Yep.
If you think about a nuclear reactor, what's the biggest cost? Well, it's building the darn thing, and then it's operating, and the regulatory burden is immense, right? And so you could say how much of that regulatory burden is necessary, how much is really safety related criticality from a safety criticality standpoint versus just paperwork, but they're big expenses.
Yeah.
When you start looking at the smallest expense at about 20% is the front end fuel cycle. Now, what does that include? That's uranium, that's conversion, that's enrichment, that's fabrication, and that's getting it into your reactor. Of
Right.
that, right? So about 40%ish of that is uranium. That's what it is. So could it be 8%? And if uranium's down in the toilet, could it be 3%?
Yeah.
But where you real 5%, but versus 80 or 90 for the other things. Now, does it matter? Sure. In the U.S., where there's merchant markets, it's a competitive market. Natural gas prices have been low. Wind and solar, subsidized wind and solar, have hurt it. But the overall cost worldwide to these reactors is single digits for uranium. Now, for the front end fuel cycle, it's different, but that's not the pound to pull it out of the ground. But now, where you really see that is in the contracting cycle. I'll read you some numbers, Matt. It's quite stunning. When you were looking in 2003, when you had uranium at $15 long-term price, average long-term price of 11, and the spot price of 10, you saw 70 million pounds contracted. When you were in 2004, the average spot price of 1860, and you saw the average long-term price of 25, you had 90. When it got up to $25, so now it was from 1020 up to 25, so it gone up 2.5 times.
Mm-hmm.
The next year, you saw 240 million pounds, and then 225 and 215 as the price kept going up. So they were buying a third of what they were buying at the bottom and loading the boat at the top.
No, I understand.
And why is that? Because they were worried about the security of supply. Now, when you go back to the last cycle, there were 22 reactors under construction when it started. There was significant new mine supply coming online, upwards of 20% of existing supply. And you fast forward to today, there's those 55, 56 reactors under construction. And with the exception of a potential in Spain for a few million pounds, the price of uranium, where it sits today, there's not a project on the planet that will get financed to do that. And you're seeing production coming offline.
No, I've seen that. I think it's well documented. You've been very good at explaining some of your pieces previously. The price is nowhere where it needs to be. It's nowhere there. But do you think as the market develops, we're going to see a rapid increase? I mean, what's your sense of timing for all of this? Because I'm put my investor hat on. I want to know, should I be piling in now, or can I wait for 12 months, invest in some other stuff, and come back in to uranium at the end of this year, beginning of next? I mean, what are your thoughts on this?
If someone thinks that that's an individual decision.
Yeah, for sure.
So what are they going to do? What's the opportunity cost of their capital being flat down a little bit? And what's the upside if it works? And if it works, what's the upside? That goes all back to risk reward. I'll worry about my downside. What gets uranium back to $10? I don't know what it does. Another meltdown, God forbid, maybe. It's 25 today. Just from the sheer reactors under construction, and they use 3x the amount of fuel on the initial load, the demand is there. The supply isn't there. In the primary market, the secondary supply isn't there. But my worry every day is what gets it back to 10, 12, 14, 15, right? So I got to knock those down. Those are more outside events outside of my control that would do that. None of it's in my control, but in terms of that, you can quantify. So now in terms of when does it turn? If we go back to the fourth quarter of 2017, now the uncovered demand, a very important point I want to make here. I went back to saying 03, 04, you had virtually no uncovered demand, very small over the next couple of years by utilities. But they started coming into the market and their contracting went 55, 70, 90, 240, right? Mm-hmm. In the fourth quarter, as you start to get into 2020, you're into the mid-ish high teens, and then it gets into the 20s, and it rapidly starts to accelerate of uncovered demand. Mm-hmm. In the fourth quarter of 17, you saw reasonable size requests for proposals from the utilities, the US utilities in the marketplace for uranium. Now, they have not really had sizable price discovery for a while. And there's an interesting thing that happened in the market that hadn't really existed 2012 through 2016, 2017. And that's something called the carry trade that was introduced into the uranium market.
Tell me about that. What is that?
So if we go back to 2004, 2005, as they're ramping in ramping these big contracts, what you started to see is those start to expire in 13 and 14 and 15. Now, in 2011, Fukushima had its accident. There was the accident there. Some of the big investment banks who have commodity trading desks, very smart. They were working in an environment with 5,000-year low interest rates. And they went to the utilities and said, listen, as your contracts are rolling off, don't enter into long-term deals because we don't know where the price of uranium is going to be. We're not sure, right? It's at this time, it's in the 40s and 50s and coming down, but we don't know where it's going to settle because you guys don't have really a lot of uncovered demand. Japan is not coming back online like people had thought it would. The United States Department of Energy is selling uranium or bartering uranium to pay for the cleanup of 2 old gaseous diffusion plants. Let us use our balance sheet. We'll charge you a fee. So, and we'll carry it. That's the term, carry trade. We'll carry it and we'll go out and buy it. So buy 1-2 year deal with us and we will hold it and deliver it to you in the future. And all of a sudden the utilities are saying, well, wait a second, we don't have to lock into a 7, 8, 9, 10 year deal. We don't have to buy market escalated price. We don't know where it's going. We can really reduce our risk. That became like crack cocaine to utilities. And 12, 13, 14, 15. Now the big guys who started at the banks aren't in the commodities trading business anymore. But for many years, it was a very meaningful portion that created this lack of price discovery. Now there's contracting taking place, but not when you're going from 70 to 200 million pounds, that's a difference in what you're going to see.
That's interesting. So you're saying that lack of price discovery is, had a meaningful impact on the marketplace.
It's had. Now there is price discovery. There's always some long-term contracting taking place, but as you look at the volumes, let me tell you the volumes in the long-term volumes. You went from 240 million pounds in 2005. You had 24 million pounds contracted in 2013, 77, 80, 70. I mean, nothing compared to what it had been. And so it had fallen off a cliff. Now, so you started, and the the utilities are saying, well, why should I? Because I've got these carry trades. Now the carry trades, as rates start as they come off the bottoms and you start to see people trying to raise rates, there's less of an appetite for that. And that's been much more muted. And so you're not seeing that occur as much.
So you have these kind of synthetic products out there, affecting conventional behavior, but where's that sort of come and gone in a very short space of time? And I mean, you said people don't feel so strongly about those now. I mean, what's happening now?
So now in the fourth quarter of 17, you start to see some RFPs.
Right. Okay.
In the January 18th, I think it was, of 2018, maybe January 15th, I forget the exact day, you see the 232 petition filed. Well, so what did that do? Now, these contracts are not negotiated on a telephone call. They can take 3, 4, 5, 6, 7 months. They can take a long time, right? There's a lot of stuff that goes into it. Very smart people on both sides trying to figure out how to negotiate it. So now the U.S. the U.S. utilities are saying, well, wait a second, let's step back. We don't know what's going to happen. Now the U.S. leads the charge. They're the biggest out there. Mm-hmm. We don't know from whom and how much we're going to be told. Now that's January of 18. Nobody knows at that point if the Department of Commerce will even pick up the investigation. In July of 18, they said they would. And they had 270 days, 9 months. And on April 14th, in July, they said, we'll investigate. In April, they made their recommendations. Now, what that has done is it has created paralysis, because the utilities in the U.S. simply don't know what they're going to be told they have to do. So when I say real price discovery, it's that utility that's going in to buy 5 million pounds a year, every year for 7 years, 8 years. What's he going to pay for that? Right now.
And presumably, what are the conditions under which they have to pay, which we don't know.
So what's
at the
happening in
moment,
the spot market, and when you look at the bought to consume, when you look at 05 to 12, the utilities were buying 136% of their needs. Okay, they were overbuying. From 2013 to 2018, they were buying 72% of their needs. So where's that come from? Where's the balance? Inventory drawdown. And that's where that's come from.
Yeah.
So now what you have a spot market that is tightened, right? And if you listen to the Cameco call, Cameco said, we couldn't find 1 million pounds, right?
And is that the case they couldn't find £1 million, or they couldn't find £1 million at the price they wanted? How do you work that out? They would have paid. They couldn't take delivery. Now, what's that mean though, when they couldn't take delivery?
So the uranium market is a big swaps market.
Sure.
Right? There's different
paper
origins.
Paper everywhere. Yeah.
It's paper, right?
Yeah.
And the swaps market was very, 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 very active. But now when the swaps market is dried up and you need to actually take physical delivery, it becomes a different ballgame.
Yeah.
It becomes harder to find. So they were not able to fill 1 million pounds of demand. Now, I said these utility buyers are very smart people, and they played the cycle very, very well, right? And they really did. Now, why? They stayed out of the market. They did the carry trade. They came into the market at the end of 17. Some of them started the request for proposals. They didn't know what they're going to do. They pulled out of the market. But what's been happening in the spot market? Average volumes over the last, from 2001, 40 million pounds a year. In 2018, it was 89 million pounds. Now, there are those who would say, well, all these financial players. I can promise you, I am at all of these major nuclear power conferences, and I see the rosters. There's 3 or 4 of us. Right? So who are the financial players? Because Yellowcake, they bought 8 million pounds last year.
Yeah.
UPC buys a little bit. A couple of family offices buy a few 100,000 pounds. These are people entering the market. Some traders, there's trader activity taking place, but the spot market's ramping up because the utilities are bright people, and they know that inventories are tightening. They know that uncovered demand is out there, and they need to start getting price discovery.
So let's say, again, this is fascinating to me because I don't know a lot of this. So it's always interesting to listen to someone like you. But, can we just talk about the impact of people like Yellowcake and UPC in the marketplace? Because, again, as an investor, I've got to make this call as to what I think the equities is doing. Should I be going ETF? Should I be buying physical? Because
the uranium ETF is a calamity,
right?
And it's it has. I mean, the assets have been cut. In the middle of last year, they decided to reconstitute the ETF, and they went from 100% miners to 40% miners, and the rest nuclear power players. But
right.
They have a gold company, they have Korean and Japanese, they have conglomerates in there. It is nothing close to being a pure play. Now, when they first announced that, they had to go from 100 down to 40. there was a lot of selling
Sure.
of those equities to do that into a market that junior miners don't trade hardly. They're very illiquid. So that for several months you saw big pressure on the equities.
Right.
What Global X, the ETF, miscalculated was, uh, well, a lot of people aren't going to want to own this because it's not a pure play. So you've literally seen the assets get cut in half, and every day we track that, and you see they had 100. They have a withdrawal. They got to sell those stocks, and so it's been a very technical
That's
reason
interesting.
that's been.
But notice you didn't discount the buying physical, because the price moves, the price moves. You get an immediate reaction, immediate value creation there. So is that something that you guys look at with your fund?
Well, so we can.
But you're saying
So there's how do you play this, right? So there's the physical players, and what you do when you own the physical, you take out the bullshit risk, right? Of some of the junior miners,
exactly,
right?
The direct correlation to value creation. Yeah, I get it.
And some of them, not all, but the junior mining business, right? I mean, these business, not all, and again, it's up to people to do their own homework and determine what's solid. But some of them are in the business of raising equity all the time, and so you have to determine what's a good project, what's not. But so how do you play it? You can play it. I can go buy physical and store it, right, with my fund. You can buy UPC or Yellow Cake, which is a physical proxy. Now UPC will give you exposure to UF6 as well as uranium U3O8, and then the ETF is not great, and that's seen massive withdrawals. Now I saw they're putting together an index of pure play miners. I haven't seen the ETF surrounding that, but you can see that. And then you get into producers, near-term producers, and then exploration companies. And right now, that comprises your 50-ish or so companies.
Okay, so this is the bit I really want to get into. So as an investor, I'm looking at the uranium space. I'm buying your story, I'm going, there's a huge deficit here. It's a tsunami of demand waiting to happen. But as you say, there are the good companies and not so good companies. What are the components that you look for when you look to identify a good company versus a bad company? Because for me in conventional mining, I know what those signs are. Is it any different in the uranium space? There are 50 companies at the moment, and you split them up. I'm not quite sure how it breaks down in terms of early stage explorers, etc. But how do you break them down?
Well, it's interesting. The market has helped do that it's culled out many of these companies over the years. There's still a fair amount that's out there, right? So you start at the top, and especially in mining, who's done this before? Have they done a good job, right? Do they have a history of doing well? What did they do in the last cycle? Did they make money for shareholders, right? That's very important. What's the quality of that?
Right.
For me, and I'll tell you, I read a few hundred pages a day. For me, there's nothing like reading annual reports going back to the beginning of the last cycle and all the way through. I've read every Cameco report you could think of. I've read all these juniors that are out there as far back as they go. You read them. You watch their presentations, right? YouTube's a fabulous tool. It marks what you've said. And so go back and look at the interviews, go back and look at the annual reports and what they've said in their management discussion and analysis, and just read it year after year and see how much has changed. Like, did they promise X and X never occurred, and now they're promising Y and promising Z? The risk you run investing in these junior companies is they're kind of like biotech companies. Biotech serve as the outsourced R&D arm of pharma, if you will, big pharma, right? And one of them is going to, 2 of them, 10 of them are going to come up with something, but a lot don't. They're really in the business of issuing equity to keep funding R&D.
Right. So
some of these junior miners just keep issuing equity, diluting shareholders to keep drilling projects that are going nowhere.
Right. So I mean, at the moment, it kind of sounds like uranium's just like any other commodity, really, in the sense that you're looking to the management to inform your decision making, and I agree with you. You should look back over time and see if they've kept their promises.
Don't just look at but you can't just look at the management, because They're all they're all polished,
No,
right?
I
And they
agree.
all tell a good story. You got to look at their track record.
Exactly. So we're coming to it. It's the same thing. Is that you look at the management team, you listen to what they say. Have they delivered shareholder value before? Have they delivered a project like this, possibly even in this jurisdiction before? Is there anything kind of specific to uranium? Because you've not mentioned any technical component yet, but I suspect a lot of your diligence does involve looking at the company from a technical
Yeah,
perspective.
so sure. So there's a big school, there's wide school, various schools of thoughts on this, right?
Right.
And I think you have to think about it in terms of second level thinking, in terms of how the cycle plays out. So if let's take a trot around the uranium world,
Okay, fantastic.
geographically. Let's do a geographical trot around the globe, right? So Kazakhstan is Kazakhstan, and they have JVs, and you're not going to have direct access to that. If you invest in Cameco, you might, right? But that's through being a shareholder of Cameco. But as you think about the world, so Kazakhstan, lower grade ISR mining, pumping it out quite a bit. As you get to the highest grade uranium in the world by orders of magnitude, is the Athabasca Basin in Canada. Severe high grade. You can get grades into the average grade around the world is 0.1, 0.1, right? 0.2. You can get grades up there as 20, 30, 40% uranium. So meaningfully higher. Now, on paper, that is very attractive because the higher the grade, the better the economics for the miner, right? Now, so where does that come into play? So the Athabasca Basin is a big basin. There's the East Coast, there's the east side of the basin and the southwest side of the basin, right? The newer discoveries have been in the southwest side of the basin with some really beautiful, wonderful deposits. And the east side is where you see the bigger, more established ones that are there that have been around in MacArthur Rivers. Now, what one has to ask themselves is, what is the market and when is the market going to pay up for those big, juicy deposits that can go into production? The market has to ask, people have to ask itself, when will they pay and who will pay, right? So for someone to blindly say on any company, oh, they're up there, oh, they have this grade, and therefore I'm going to buy the stock. You can't do that. Each company is different. Each management team is different. Then you have explorers that are up there that haven't found yet. Right now, I have access to geologists, mining engineers that because I said earlier, I don't know either. I'm not a geologist or a mining engineer. I'm smart enough to know people who do, and I can talk to that can guide me and help me. That don't work for the company because that's where you go off the rails. So you have to ask yourself is, because what's the goal of a junior miner? Most don't want to go into production. They want to get taken out.
Of course.
Right? That's how you're going to see it. That's the game. So when is the market going to pay? And you have to ask yourself, is there infrastructure? What's the cost of this project going to be? What's the appetite right now for a large cost project for somebody to buy their shares today? It might be different in 12 months, 6 months, 18 months. It might be meaningfully different. When the green shoots that I see every day in the industry start to pop through into when I'm talking in the fuel cycle, I see when you see it through price discovery, that's when psyche changes, sentiment changes, and then all of a sudden, are people going to pay for that stuff? Yes. As I look in the U.S. mining industry, right? They're small companies. In the global landscape, they don't mean that much. Now, some of them are materially mispriced based upon who they are and what they can produce. Now, 232 has thrown a kink in that only because you don't know which way it's going to do. And to the extent that the 232 petition did a disservice to some of the U.S. companies, because as you and I spoke about earlier, I think there's a shortage now, and there's going to be a shortage, and they'll get their fair share of it, and it's all good. But when a decision comes out from Trump, it will be treated as a binary event. Somebody's going to win, somebody's going to lose.
Yeah.
Right. So, but the grades in the U.S. are low. The size of the projects are small. And so you just have to look at the individual companies. and look at it. And how do you get bagged? What people tend to do is there's buy the pounds in the ground game. So many companies go out and keep acquiring pounds.
Yeah.
And the market will look at it on an enterprise value per pound basis, right? So EV per pound. Well, if I have more pounds in the denominator, I'm going to bring down my valuation. So I look cheaper. The game some companies play is they buy bullshit pounds. They buy uneconomical pounds. And all of a sudden they trumpet how many pounds they have. So just to look at it on an EV per pound basis, you're doing yourself a disservice as an investor. What you need to do is look at their core projects and see what the cost to build is going to be, see what the internal rate of return is going to be, what the cash flow from that's going to be, what is the net asset value per share based on that, what is the cash flow multiple the market's going to pay for that, right? Or they're generating X when they go into production. You have to ask yourself, do they go into production at what price? You got to understand that. How much can they produce? And then you have to ask yourself, what's that cash flow stream worth? But just doing it on an EV per pound on a ground basis, you're going to get run over because people are going to, a lot of companies have bullshit pounds.
No, I think I understand that, and I think that's probably very similar to a lot of mining businesses. You've got to look at those things, and you're coming at it from an analytical point of view. Are there other things which are more, are they fully permitted? Do they have the licenses in place? Are you comfortable with the jurisdiction? Yeah. I mean, how do you?
Yeah, well, so in uranium, it's it can take like many mining industries, but it could take you 15 to 20 years from exploration to actually having your mine there, and so it's very important to understand. And that's a good point, Matt, because as you look at the world of uranium and the geopolitical aspect that comes into play is very important. Because if we think about what we said earlier, China and Russia are really leading the nuclear fuel cycle for the years to come. One of the things neither one of them have as much uranium, indigenous uranium. They don't have it. They have a little, but not a lot. So they need to go out and acquire to be able to vertically integrate. The uranium's a critical portion of that. So they need to go out and buy pounds. They need to buy projects. Now, where can they not buy? The Russians aren't going anywhere in the West, and no one's allowing them to do that. You had the Uranium One deal years ago, but that's done. And the Chinese could take a minority stake, but nobody's going to grant them full ownership of something. Just for geopolitical purposes. So where can they go and buy meaningful pounds? They can go into Africa, they can go to Niger, they can go to Namibia, and they buy, and people say, and so investors might look at it, really sharp investors, and say, yeah, but gosh, the grades there are terrible, they're low, they're expensive projects, it could be a few $100 million, $300 million to $700, whatever, $100 million. Oof. You got to understand the motivation of the buyer. The buyer needs pounds. The buyer being China, Russia, a Middle Eastern sovereign wealth fund. The Middle East is growing like crazy. India needs a huge amount of pounds. And they're state subsidized. So they don't really necessarily care what the cost to pull it out of the ground is. They might pay to finance the mine in return for an offtake agreement, right? So what's the second level of this stuff? Not just who has the best, highest grade uranium, it's who is going to be the one that's in play as the cycle unfolds. And then what are those valuations? And how do they compare to where they're trading now versus historically where they have been, and what a reasonable buyer would pay for them?
Nice. Yeah. Thank you for that. Thank you for that. So if I was to sum up from an investor's point of view, so there's the financial ratios, whichever you choose to apply to the company, and the geopolitical component is clearly important. And we're talking today about equities. We've talked a little bit about physical, but mainly equities. People are going to be saying, right, where should I be buying? Should I be buying US stock now? Should I be buying the Australian guys? Should I be buying developers with pounds on the ground? Should I be buying producers? I mean, today, nothing's really moving. But if they were to buy something for the future, where would you be pointing them? Or would you advocate a portfolio approach?
So everything starts with the macro in uranium. You could have the best uranium project in the world. You could have the best management team in the world who's made money before. If the price of uranium doesn't move, it doesn't matter.
Yeah.
Right. So in that case,
you got to believe the fundamentals for sure.
If you believe the fundamentals, then and you want certainty, or not certainty, there's no certainty, but if the fundamentals are right and it works, the physical will go up. Right. So how do you express that? You buy physical, you buy UPC, you buy yellow cake, right? That's how you express that view.
Right.
If you say, okay, I want to take on some more risk and have more exposure to the operating leverage in a mining business when the price of the commodity goes up, your choices are producer, near-term producer, exploration company.
But you would definitely think about a producer. That was like for uranium, it's something which would deliver value.
I think absolutely. I personally think the valuations, and I don't talk individual companies, but along producers, near term and exploration, the valuations have been decimated, and there's real value. Now it depends, right? So I see a lot of people ask me, where's the price going? 150, 200, right? I have no idea. The market will determine that. And fear and greed will determine the price of uranium. If history is any indication, last cycle, it went from 9 to 137. Now and again, this is an important point, I think. There were 22 reactors and new supply coming online. Now, what curtailed that new supply? In 03, 04, MacArthur River flooded. In 05, 06, and 06, 07, Cigar Lake had 2 floods. But now you got back to no supply coming online. Today, you got 2.25, 2.5 times the number of reactors coming online and no new supply on the horizon unless the price gets to 50 plus. So you say, okay, well, I think the backdrop is better. Now, I also think the fuel buyers are smart people. In 17, they started to come into the market. Now, they're not going to stand up there ever and say, yeah, we're good. We're good with the price. They're going to fight you tooth and nail for it. That's their job.
Sure.
Right. But that's why it's so important to lay it out. Lay out every year, the volumes, the spot prices, lay it out. What was the pounds bought, the drawdowns, the bought to consume? I mean, you got to do the work. And when you do that work, what jumps out at you is saying history, it doesn't always repeat exactly, but it rhymes. And what you'll see is as the price starts moving, they'll start coming into the market. So for us internally, our projects, we go up from $55 to $70 is the price we use. So where does it get there? Now the question is, when does it start to get there? So 232 is going to come, in theory, by July 14th.
Right.
And one way or the other, it's going to be perceived as binary. Some stocks will go up, some will go down. Over time, I think the market will realize that there's a deficit. Now, when will they realize that is when you start to see price discovery. So what happens? Because I'm on Twitter, I see sentiment. And because I'm a public voice of uranium, it comes at me all day long. I keep it off most of the day, and then once in a while I'll check in on it. But people are not focusing on the number one thing that is the most important thing that most people have the opportunity is time arbitrage. Doesn't matter if it's this quarter or next quarter. And what's happened is 232 is going to come, and people are going to say, holy cow, today we didn't see that contract come. The day after 232, we didn't see it the next day after. Everyone has to sit back and understand. The utilities are going to say, well, what does this mean? How does this get implemented? Now, what they're doing now, what the fuel buyers are doing now, is they're out talking to miners, understanding what production capabilities are. They want to know, right? So they're smart people. So over a period, is it going to be a quarter or two? You're going to start to see that come. All of that was pent up in fourth quarter of 17. Those RFPs come back, and that's when you start to see it over the next couple of quarters. So people ask, where do I expect the price to go? predicting the price of a commodity is a fool's errand. Now, in the price of uranium, where do I know that it has to go for production to come online? Well, Cameco's not going to bring online unless they've lost their mind, and I don't think they have. You're going to need to be north of 45, right? Cameco says on the call, and I have huge respect for those guys, they say on their conference call, well, don't forget that there's tier 1 and tier 2 assets that could come back online, and there's financial players who have it. Yes, that could be at $45, $50, $55, $60. Now, if you're Cameco and you've seen $1 billion in cash flow get cut by 2/3 over the downturn, are you going to jump when you get the price to 45? Are you going to say, okay, sold to you, we'll take it all? No, that's not a market commercial behavior. You're going to now have to make up for all that capital that's disappeared and all the shareholder value that hasn't been accreted. These aren't unsophisticated players. Same thing with the yellow cakes and the UPCs. They're not selling uranium, I don't think, at 30, 35. Once the market starts moving, now it becomes a seller's market, not a buyer's market. And so that's where I think you start to see it move. So I think when we think about, we sit around, my team and I think it's do you see at the end of the year, can you see into the mid-ish 30s? Yes, sure. And that's, I think, healthy. What do I use longer term? 55, 60, 60, depending on the project, $70. Do I think you could see a spike? Don't forget, spike to 137. It depends what the market wants. You don't need it to. And that's the thing about buying these equities when the physical price of uranium is in the mid-20s, which is where I started this journey.
So just on the equities thing, because I do want to get onto just one more topic, because it's, like I say, there's just so much to cover here, and I think we've said we will talk another day on specifics, but just on the equities component, do you think that there is still, even with this deficit coming up, it should bode well for lots of people in the uranium space, but do you think that there will still be some casualties in the equity space before we get there?
That's a great question. So my DNA is a short seller. That's exactly how I made my living for half my career, and even the second half of my career, I was an aggressive short seller. In my fund, I don't short anything.
Okay.
And the reason I don't is because when the cycle turns, what you typically see is the shittiest of the lot will move up enormously.
But given you can't determine, or you're unwilling to determine, I think sensibly unwilling to determine the timing on this, there are going to be companies running out of cash, even if they're sitting on reasonable assets. And as you say, there's going to be...
but if you get uranium at $35 spot by year end...
If they can make it that long, yeah.
Well, but you asked me saying I'm not willing to determine, sure. If it's at 35, which I think it should be, then, or 34, 37, that sentiment change will.
You think they could raise capital at that? It'd be expensive capital, but they could raise it just to survive.
They've been doing it for 7-8 years. And unfortunately, retail has financed these stories. Right?
True.
They financed stories when the price of uranium was 17. They financed stories when the price of uranium was 19. What you don't do in Australia and in the UK, they do here is they give warrants. So they'll give 5-year warrants. Now that's up to the individual shareholder to determine. Now, what I do see is a lot of people will say, you know what, these guys are going to have to go into production and they're going to have to issue equity. Well, they're going to project finance these things. It's going to be 80% debt, 20% equity. And in your math, you have to do that math. And maybe it's 70-30. Assume dilution and carry your numbers forward.
Yeah. Well, it'd be interesting to see what happens between now and Christmas, I guess, because I think our analysis suggests that it's going to get a bit hairy for a few between now and then. Look, again, just be conscious.
Hairy for what?
For some of the juniors sitting on, maybe with pounds in the ground, but with not a lot of cash, will they be able to make it through? And will they be able to raise capital at the price that they?
I have no opinion on that. I don't stay.
No, I understand you. I understand.
But But don't forget, if they're a Canadian, they get flow through financing.
Yeah, yeah,
That will keep them afloat.
yeah. No, I understand.
The thing you see this cycle is where it really becomes a problem is when you got debt. Virtually, not all, but most don't have debt. So it's just a matter of issuing equity, telling a story, and finding people who are willing to finance that story. Where it becomes where you see companies get in mass wiped out is when they've got interest payments to make and they can't make them.
Yeah, for sure. Like I say, it's the same for lots of commodities, over the past few years. Like I say, I guess we'll sort of sit back and see, and perhaps it's a discussion we can get into a little bit deeper next time. But can I throw a question at you with regards to nuclear? You empower the nuclear industry, literally. Do you think nuclear is a transitional energy source? Do you think people are going to try and become green? They're moving away from fossil fuel. They want to go green. Nuclear has positioned itself as a green, clean energy, and I think it's doing a really good job of that. You're still going to have some naysayers talk about, toxic waste and all sorts of issues that need to be dealt with, and those may be real and meaningful issues that do need to be discussed. But in the meantime, it's we're talking about zero carbon energy from nuclear. It's doing a great job promoting itself. But will it survive? You're talking about a depleting asset potentially in terms of is there enough of this to go around, and at some point it's going to run out. So if it is a transitional energy, how long will it be around for? And is there money to be made?
Well, in the last 15 years, it's gone from 16% down to 11% of electricity generation. Wind and solar has taken some, natural gas especially.
Yeah.
I think the questions people need to ask, don't forget, 99 reactors in the United States, right? But now over 100 gigs of electricity. And what's hurt that here in the U.S.? Well, I would argue low interest rates, Fed experimental policy of easy money has created the shale boom, which has taken natural gas, which at any point in time traded $6, $7, $8 per MCF, even went higher, down to 2.5. And if you look at the shale plays, 2/3 of them don't make a dime, regardless of the price. Depletion rates are enormous. The ongoing capital expenditures to stay ahead of the depletion rates are staggering. They have hundreds of $billions in debt coming due in the next few years. In the latter part of the year, early part of this year, you're seeing investors starting to step back a little bit from wanting to finance that. So one of the constants and givens, at least in the United States with this shale energy independence, is that natural gas is going to stay low forever. It's going to be $2.50. Natural gas at $5 turns the economics upside down for a nuclear power plant. So, but the recency bias of what's happened because of stupid, cheap, easy money for anyone to finance these things for these shale plays, which are, most of them are not economic. And you're starting to see activist investors come in and starting to demand production cuts, right? So does it happen tomorrow? I don't know. But so in terms of longer term, I'm not so sure that, and I'm not a natural gas expert, but I'm a common sense guy. And I am a capital markets guy. And I know that for a decade, these companies just piss money down the drain. So I think that's that environment. Around the rest of the world, I think wind and solar grows. I don't think it displaces nuclear because it doesn't have the storage capabilities. We're going to hear everyone say, "Oh, storage costs are coming down. Costs are down." Look what's happened in Germany since they've gone green. Hundreds of billions of dollars spent. Carbon emissions are up. Cost of electricity is up. It's a complete shit show for them. And their neighbor, France, who's 75% nuclear power, has half the cost of electricity and are meeting all of their climate goals. And the growth you're seeing in the Middle East, the growth you're seeing in the developing world, I think it has its role. Does it go to 10%, 12%, 9%? I don't know. I know for the purpose of any forecast period I could look at over a decade, I think it's going to be a critical part of the electricity generation in the world.
Okay. Okay. Again, I think that's probably one for another time, because I think that's a really big topic. There's lots of people coming out from both sides, very passionate about their position, and I'd love to talk to you a little bit more about that one. So I'm going to finish with one big question for you, which is anyone making money in the uranium space at the moment, and how?
I mean, well, so Cameco's generating EBITDA, right? They got some cash flow. Aside from that, no, you'd be hard pressed to find real profits in the uranium space.
Okay.
I mean, Kazatomprom. But
So-
if you're looking for profits, you're in the wrong. You shouldn't be investing in this right now.
Right now.
At the depth of a bear, if you're looking at returns on capital, if you're looking at who's generating profits, at what is the, I think the bear market ended, but this is not the cycle to be investing in.
Okay. No, that's fair comment. Now, I'm going to let you sign off by explaining. I saw this piece you did, kind of comparing the uranium space to The Big Short. I really like that. You know, you were saying, you're explaining how the subprime loan space and the subprime bond space has had no correlation, although they should have. And is that you're kind of saying that about what we're going through at the moment? People should see what's coming down the line and be optimistic.
There is a complete disconnect between the fundamentals that have dramatically improved over the last couple of years. 20% plus of world supply has come offline. The secondary market, which has been the 800-pound gorilla of supply, underfeeding, whether it is conferences I speak at, they're there and stand up and say, we are reducing the underfeeding. So that has peaked and is coming down. Supply is coming down. Uncovered demand is right in front of your nose. I went back and looked at a lot of bull cases in 2014 and 2013 and 2015. YouTube's wonderful, like I said.
Yep. Big fan.
You've got a carry trade, no long-term uncovered contracts, uncovered demand. You've got the Japanese having marine reactors online. There was no bull story. The uncovered demand is what drives this. Supplies, inventories working down. And back that time, 13, 14, 15, they were coming off of buying years of 250, 40, 30 million pounds of inventory. What happens, though, is this is a closed loop world, unlike anything I have ever seen. It is an opaque market. It is not followed by institutional investors. And I'm sorry to say, retail investors, while they're very bright people, and whatever they do, they're great. And I see some really smart ones do the numbers. They've kept many of these companies afloat by financing them. And but building the numbers out, rolling them out, and putting it, the numbers in this industry are predicated just kind of like a ratings agency. We make that correlation. But the rating agency says everything's fine. It's AAA tranches in AAA tranches. It's all good, right? It's AAA rated. The number makers here, the consensus makers here, bright people. I always, but I think that they're either handcuffed in how they can forecast the numbers, or are so afraid to put their neck on the line that they put numbers out there that you can drive a freight ocean liner through, like I said, and which allows you to morph to wherever the market is at any given time. And that's fine if you're in the business of doing that. If you're in the business of putting your balls on the line and making money, you better do your own analysis, and you better be right? Those kooks in The Big Short, those crazy guys who were trying to see what everyone else wasn't seeing, they didn't care what the rating agency said. They did their own work. And that's kind of how we view it. I don't care what consensus says. We've done our own work, and we believe strongly. Now, outside influences come in at 232, right? Comes in. 232 is not part of our thesis. It still isn't part of our thesis. We didn't even know what it was at the time. All it does is take a little time for the pause in buying. Another thing I saw on Twitter, somebody said, ask me about the Irano strike. This could be a big deal.
There you go. Yes, that was one.
Okay. Well, so what winds up happening is people bring up what's the thesis on uranium, right? Global oversupply leads to uneconomic pricing, leads to production cuts, leads to reduction in primary supply, secondary supply in a demand environment where uncovered demand is accelerating and contracting cycle is going to start. That's the thesis. Now, 232 is noise. Somebody, like I said, whether Irano could settle the strike at their mill, it's not a strike. Their labor in May. If they don't, there could be a strike.
Right.
Who knows? It doesn't matter. Does it mean if a strike comes that yes, that is good because you could see 18 million pounds come off the market? That's great. But what it sets up is this. Nobody knows how those labor negotiations are going to go. It's not fundamental to the thesis of uranium for it to move. What it does do is if the strike comes into, if there is no strike, it sets people up for a disappointment that was unnecessary. So if it happens, great. It's a cherry on top. If it doesn't, who cares?
Yeah.
That's kind of how I view that.
No,
so, yeah.
Mike, that's been fantastic. Like, the reason we wanted to speak to you is because you have this view on the marketplace. You are doing your own analysis. You are giving us insight which wasn't there before. I think you're deeply respected by a lot of people in the marketplace, and we like to thank you for the work which you share with us. There's a lot we've talked about on a very superficial level. I'd love to deep dive into some of that with you. Again, real soon, because I know the market loves hearing what you have to say, and so do we. So thanks again for your time, Mike. Thank you very much for watching our video. We do aim to give you informed and intelligent information with which to make your investment decisions. So if you liked what you just saw, please give us a thumbs up. And if you want to see more insightful, in-depth, honest and unbiased interviews, then please click the subscribe button. So thanks again for watching, and we look forward to seeing you again soon.